Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Michael, when considering why banks should care about enterprise risk management, there are two particularly significant thresholds when a bank approaches $1 billion in assets and $10 billion in assets. Why is enterprise risk management especially important in those two instances?
Yeah, great question. And first of all, a lot of those two growth points have a lot of significance from a regulatory examination perspective.
Okay.
So, if you're managing a bank that's 900 million and a bank that's, over $1 billion to 2 billion, it's going to feel very much similar. And as a matter of fact, there's no magic point, where a flag comes up and says, boy, now you're crossing over $1 billion, and this is the exact time that other infrastructure needs to be put in place. But regulators look at that moving over the $1 billion an asset mark as a way to really focus on banks to say, do you have the basic infrastructure in place that you need now that you're hitting $1 billion? And we get calls from a lot of banks that whose regulators have been in, they're 800 million, 900 million, and they ask the question, are you guys ready for going over $1 billion? When it comes to the actual regulations themselves, there's not a threshold at that $1 billion mark. That's quite different from the $10 billion mark, which we'll talk about separately. But it's almost a growing up, so to speak, in the regulator's eyes, where a bank has a certain size. And here's a few things that you'll want to consider hitting that $1 billion in asset mark. Number one, if you don't have a chief risk officer when you're approaching $1 billion, hiring a chief risk officer, shortly after going over the $1 billion, I think is a good idea. And this should be a position that reports to the CEO or the chief operating officer, fairly high level in the organization. Doesn't have to report to the board, doesn't have to report to the CEO necessarily. Sometimes we see them reporting to the chief legal officer.
Could that CRO, the chief risk officer, wear multiple hats? Could that person also be responsible for compliance or other areas? Or really, as you get to that $1 billion mark, is it wanting to partition that risk position off independently and autonomously and separately?
Yeah, in some cases we see separate hats. For instance, the most likely hats that we see were a chief risk officer overseeing the compliance hat or vendor management hat. So those are real common hats. And in many cases, the chief compliance officer gets appointed to that chief risk officer role. So they carry that hat with them. There's certain areas that, I would recommend against having a direct report. A chief risk officer reporting to a chief financial officer. And the reason is that the role of the chief risk officer is to independently assess the first line, which could be the chief operating officer, chief financial officer. So they want to see the first line, which is the business, manage control separate from the second line. And the second line is defined as an independent risk organization, independent of the operations, separate then from the third line, which is internal audit. Now, still at $1 billion, we start to see the chief risk officer overseeing audit and risk management. And for a period of time, I don't think this is, a big issue, but eventually internal audit, you'll want to report separately to the audit committee of the board, and then risk management to either the risk committee of the board or the full board from a reporting standpoint. So separating that first, second, and third line of defense out. Operating departments is first line. Risk management and compliance is second line, and third line is internal audit. So I would say having a dedicated chief audit executive at $1 billion and over is highly recommended, and that's where you'll see a lot of emphasis from the regulators. Having a separate chief risk officer or head of enterprise risk management is recommended right at $1 billion. And I would say more formalization around your risk assessment start to come into play, where you were doing things more informally or ad hoc. Now you'll want to do things more formally. Now going over 10 billion has a lot of regulatory context behind it. And it's a major change for banks. Number one, banks are going to be paying more on their interchange fees. So they're going to be making less money when they go over 10 billion in assets. But from a regulatory perspective, there's a handful of regulations that specify once you go over $10 billion in assets, that you'll need to put more formal infrastructure in place. And not only are the regulations there, you'll see that the regulators change structure at that point. So there's a regulatory body called regional bank examiners. And so there's a whole separate team of regulators for banks above 10 billion. Then there is kind of general regulators below 10 billion. And typically, if you're below 10 billion in assets, they have an annual safety and soundness exam for many of the prudential regulators. And there's one report that's gets issued once a year with a team of generalists. You'll get used to that. It really feels comfortable. Once they go to over 10 billion, the regional bank examiners tend to do anywhere from 8 to 10 exams per year. And they're very specialized exams, like an exam on enterprise risk management, an exam on capital management, an exam on data management. And they go deep down, and you'll find out how unready you are for an exam like that when they do start doing deep dives on these particular products and services. At the end of the year, the regulators take these 10 exams and they aggregate them together into a safety and soundness report. You know, they fill in the gaps and they create a report. So the things that you should be concerned about if you're going over 10 billion in assets are: one, have you formally looked at your risk and control structure and identified all those gaps that you have from under 10 to over 10? And so we would recommend doing a gap assessment or risk maturity assessment to make sure that you're in compliance with SR 13-1, for instance, is internal audit bar raising with a lot of additional requirements. SR 12-7 is for banks above 10 billion, stress testing, both capital stress testing, liquidity stress testing, and credit stress testing, and making sure that that's done properly. And then the bar gets raised with ERM, with model risk management, and the other topics. So I would say, go through the regulatory guidance again. Identify, do you have the right number of people in your staff? Typically, you're adding staff at 10 billion in assets. Benchmark yourself against other organizations if you can, and make sure you have the right systems in place. So going over 10 is a big deal. Most banks that we work with have outside help doing that. An outside consulting firm. Some people choose to do it themselves, and if you have a tool like the RMA's risk maturity assessment, it's a great tool if you complete that tool to identify your gaps kind of under 10 billion and gaps over 10 billion. but don't wait till you go over 10 to do the gap assessment. You want some lead time.
Sounds like the regulators will already be in there and they'll be in your kitchen at that point in time. So
Yeah.
planning and so that you can put yourself in the best position for that regulatory exam that you know is coming.
That's exactly right. And the RMA risk maturity framework is also a good tool when you're going below $1 billion to above $1 billion. While there's not a lot of regulatory guidance, you'll see that the maturity model was developed. We had help developing that tool with 10 chief risk officers across the banking industry that have been through that process before. So either utilizing some sort of tool or utilizing an outside expert to help you with those gaps. And then my recommendation is in both cases, develop a 3-year roadmap because you can't get all this stuff done, in 1 quarter or 1 year, and share that 3-year roadmap with your board and your management team in terms of what you're planning to do over 3 years. Start setting expectations that there needs to be an investment in risk management and control instead of bringing requests to the management team and board one-off. Have a comprehensive plan for your movement from under $1 billion to over $1 billion, under 10 billion to over 10. And by the way, for those of you out there, if you're going over 50 billion and now you have to pay attention to enhanced prudential standards, it's a good time to do a gap assessment as well.
So that 3-year vision or plan, is the regulator going to expect that to be completed by the time you reach that threshold, or will they give you some leeway if they see a plan that you have in place?
Ed, that's a great question. They want to see the plan first, because what they're going to do is come in, Ed, and identify where your gaps are. So you're one step ahead if you've already identified those gaps and you have a plan over time to close those gaps that's approved by your management risk committee and your board risk committee. Most regulators will just let you, go on that timeline and add that infrastructure over time. So it's your best offense and defense. It's a real great defensive strategy to have that plan, share it with the regulators, and now they know kind of what the bank's plans are. And don't forget to get board approval, the board risk committee approval, because that makes it all official for you. That puts it on a pedestal for the regulators as well as the management team.
Now, Michael, the last follow up on this question is you mentioned a risk maturity framework and you mentioned risk assessments. Can you elaborate on those a little bit and the importance of each of those?
Yeah, it's a good question because there's a lot of confusion between what is a risk maturity framework, what is a risk assessment. I've heard some people say, well, they're the same thing. The maturity frameworks are designed to help you evaluate how effective your team is in putting the structure together and putting the information together. So it's really about how good are we, where are the gaps, where do we need to improve our organization, the risk organization. And then the risk assessments are done of each unit in the organization to say, how risky is the ACH department? How risky is IT? So now we move away from how effective overall are we in managing risk to, hey, how much risk do we have in each department and in sub-department? And collectively, how much risk do we have as a whole in the bank? So it could be that you have a very well developed risk framework with the right people, the right software, but that you're managing a real risky bank. For instance, if you have a bank that has digital assets or crypto, you can be really risky, but you might have a really strong framework to manage that. So those two are separate and distinct. And I'm glad you asked that question because that can cause a lot of confusion.
Great. Thanks, Michael.